Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Todd Bubba Horwitz, a 40-year professional trader of BubbaTrading.com.
And in today's rant, Corey and I don't want to talk about the Fed again, but we kind of have to, so that's what we'll do.
And remember, if you want to send us a note, send it to feedback@investorhour.com and tell us what's on your mind.
That and more right now on the Stansberry Investor Hour. Do I really not want to talk about this? I really do want to talk about it. If I'm being honest, I want to say that I don't want to talk about the Fed, but I can't stop myself.
But you really do.
Yeah, I really do, because there's just the absurdity of its existence gnaws at me. So every time Jerome Powell or somebody, this week it was Jerome Powell, talks in public, all of that just comes right back up to the surface again.
And he certainly talked this week, or recently, in the past week, before Congress, the semi-annual required testimony before the Senate and the House of Representatives.
Right.
And we got the Fed meeting coming up, so it was timely too, as far as what he was saying.
Mm-hmm.
So yeah, and he said a lot. These guys love to talk. They really do.
They do. And they love to talk in a very particular way, which it's sort of. I will say this. Jerome Powell does talk in Fed speak or whatever you want to call it, but I think he's clearer. Like, he's not a big obfuscator like Alan Greenspan was, for example. Like Greenspan, you never really, you were parsing every other word. But I feel like Jerome is pretty clear.
Yeah, I agree with that for sure. Yeah, it's pretty, what he's saying. It's just sometimes what he's saying contradicts other things, and you got to make sense of it, of that part of what's the most important part that he's saying. But what he says is pretty clear. And what he said recently was, we're going to basically take the totality of the data, and if higher rates are appropriate, we'll do that. And the market kind of, puked a little bit the day he said that, down about 1%, 2%, depending on what you want to look at. So, it's kind of what we've been saying, this higher for longer story. Does everybody believe it still or not? It seems enough people don't, that the market reacts to these things still. And after 14 months now of this story, the inflation peak, sure, behind us. But, well, as you've said, inflation is never gone. However, the pace of inflation may have short-term peaked, but it's still sticky parts of it, and the rate plan is still higher, until further notice. The pivot's a long way away.
Right. Yeah, I'm on the same page with you, because I think that they are working on this kind of paradigm of not changing the status quo until it just becomes painfully obvious, which happened when they, sort of shifted gears from easy to hiking to, from transitory to not so much transitory as real honest to goodness inflation that's going to be around for a while. So I think if they jack rates up high enough and enough people suffer for long enough, sure, we'll see a slowdown or a stoppage in hikes, and maybe even a cut or something somewhere down the line. But I don't think it's as imminent as anybody seems to believe. And actually, to be fair, lately, this last round after Jerome talked, the market went and discounted a 50 bips cut like really fast. As soon as those comments, which. I did this once with 4 charts in the Ferris report, the first issue that came out on December 1st. Like, I showed the crazy volatility around 2 p.m. It's like they dropped the statement, and then he reads that statement, and then he starts answering questions, and the market goes nuts because, it's a little worse than, it's a little more extreme than what the statement was.
Yeah. And it's, I think, honestly, if the market's reactions during Fed talk it's remarkable. It's stuff you don't see many other days of the year, as far as up and down 1%, and a couple of hours in the end of the day. So, but I think if anything, what was interesting this time around was I think people may be getting more concerned that the higher rates are now actually going to cause some serious trouble down the road, which is I think why you might see kind of longer term bond yields falling a bit, while the short term, the really short terms, stay where they're at. Indicating like maybe okay, these rates are going higher, and then things are going to get bad, like after that. Which has been different than the past. Where it's just everything was going higher, and you're kind of like the market was reacting just to the beginning of this higher rate environment. Now it's kind of like reacting to okay, what happens next?
Yeah.
Maybe. Who knows?
Right.
I feel like it's a different moment kind of in this bear market era, which we still are in bear market, right? We're not making new highs in stocks, even though they've been up.
Right now,
a bit.
that's an interesting point, Corey, because I have had discussions recently within the last 24 hours, in fact, with folks who are saying, well, this actually looks like it could be a new bull market that started in the October bottom.
Well, yeah. Well, since October, yeah. I mean, there's been making higher lows, but still within the longer term. We're not above new highs yet.
Right.
To me, that's my definition, but everybody's got different definition.
Yeah, I don't. I agree with you. My definition would be a new all-time high, and it's worth pointing out that during at least one of the sideways markets that has happened in the past, just call it century, since 1929, a market can make a new high and then kind of it can make a new high after some years of going sideways and then go sideways again for more years, put it that way. And boy, that would freak people out, I think, because right now there's a lot of, it's a new bull market. We're still in a bear market. Do you want to be short? Do you want to be long? The entire market. There's a lot of that. And I think you can see like in sentiment, with TD Ameritrade puts out a sentiment indicator, and it's actually pretty low. I mean, it was super high at the top of the bubble, but now it's pretty low. So, I just wonder, like, at this moment, after a year plus of this, getting on to a year and a half, if you start at the top in November of 2021, with, some sentiment maybe not so great, how to think about this. Because at some point, higher rates, lower valuations mean better long-term returns. People keep contributing to 401ks. And it feels like a war. What I'm getting to, I think, is it feels like a war in the market to me. It feels like a real war. And it could go, to me, I still think the potential for it going sideways for a decade is in play.
Yeah, no, I feel you there. I mean, if you look at it, you could say we've been in a sideways markets already since June. If you go back, I'm looking at like a 3-year chart right now of the S&P 500. You peaked at around New Year's Day 2022, and then the sell-off June. We've had various, ups and downs since then around the same way. And then you could go back even farther to the spring of 2021, and we're at the S&P is about the same level as it was then, which is interesting because that is when the arcs of the world and we're topping out. And so I do think we've had kind of like a blow off of the tech, bubblicious stuff. But to me, maybe this is just like one long kind of digestion of that. And who knows, maybe it lasts 10 years,
Right. So I think I saw a recent report from GMO, Jeremy Grantham's firm. And they were suggesting that this is a great time to buy high quality, because if we do get a recession, they're going to keep gushing cash and not needing to raise money in stock market, in capital markets at all, stock or debt. And this is the time to start thinking about that, to buying high quality companies. And it made a lot of sense to me, because when we say, rates are higher, valuations are lower, returns are better. Well, not for the worst garbage, not for the garbage you're talking about that's been murdered and isn't, some of it's never coming back. And that which is coming back will take a decade or more,
Right.
Like .com peak was like, I think, what was the NASDAQ like till 2015 or something? I forget when it made a new high again. It was a long time.
Right. Yeah.
So, yeah, interesting moment, complex moment.
Yeah, I think so. It's it feels like it to me. It feels a little different than it has the last. Famous last words there. Feels a little different, but it does feel a little different. I'll say.
Yeah, it's funny because Chris Mayer is a really smart investor who always says the hardest time to invest is right now, and I agree with him. But the sentiment isn't covered by that comment, though, right? Because it's whether or not it feels like it's hard, right? It's whether or not you actually think it's hard. It didn't feel hard in the run up to the peak here. Most people thought it felt pretty easy.
Right. Yeah.
But now
I would say yes. Now it feels hard. I would agree with that.
Yeah.
And it makes me feel better that you said from GMO that high quality companies, because I just keep thinking if you own high quality companies that are just going to keep increasing their dividends or at least their cash flow, like that seems so. I'm totally comfortable with that right now. And so if those companies have fallen, a decent amount or still down 10, 20%, 30%, whatever, that to me makes a lot of sense right now for the reasons you were just saying too.
Yeah. For all my bearishness, I'm making long picks in extreme value and the Ferris report, like right and left. We're finding, of course, in extreme value, we focus on the high quality companies, and the Ferris report is more of a macro kind of a thing. But I've put plenty of individual stocks in both of them recently. So
yeah.
How bearish am I? I don't know. All right. Let's talk to somebody who has a very clear view on things. Bubba Horwitz, great trader, great guy. We've talked with him before, and it's great to have him back. Let's talk with Bubba. Let's do it right now. I'm stepping forward with the biggest market warning I've ever made. Bigger than when I called the NASDAQ crash in the fall of 2021, and bigger than when I predicted Lehman Brothers would collapse 5 months in advance. This is the clearest investment setup I've ever seen. A rare market event that's only occurred twice in 50 years. It's something most investors don't remember or are even aware of at all. And yet it has the potential to change everything. It'll impact nearly every asset you own, your cash, stocks, bonds, even your real estate. And yet, if you know what's happening and take the right steps today, you may never have to worry about money ever again. The last time we saw a setup like this, you could have made an incredible 1,000 times your money. To ensure you're among the first listeners to see my big prediction, head to www.dansbigwarning.com. Again, that's www.dansbigwarning.com to hear about the financial event heading your way right now. Bubba, welcome back to the show. It's great to see you again.
Dan, it's great to be back with you again, and I'm sure we have a lot to talk about.
And I'm here with my co-host, Corey McLaughlin. And, of course, well, Corey, say hello. You don't know Bubba, do you?
No, I don't think we've ever met, but I've seen interviews you've done and whatnot, so I'm happy to talk to you in person.
Pleasure to meet you, Corey.
So I just want to dive in because I see you often in interviews and things, and you and I are kind of in the same place. You've been talking about commodities lately, and I just saw a new tweet within the last several hours, I think it was, about commodities. Is there like a specific group or a specific metal or commodity that you like, or you just like the space in general?
I love the space in general. I mean, I think the grains are going to have a big up move. They've been under extreme pressure, and it's not logical. When I look at what's going on, the cost of plant, the cost of input, and what they're selling at retail, there's a problem in between the farmers and the retail stores. They're not making enough money. And I think that's going to be a problem. So I think those are going to explode. I like the metals. And I've said before, I think that gold will make new highs this year. I don't know how much farther they'll go, but it's always one level at a time. And I think silver should probably get back into the 30s would be my guess. And, the rest, I think consumable goods in a population that A is growing and B is short goods a lot, nobody's accounting for the shortage of goods that we have. And at some point, there's going to be, I think, a much bigger demand. Plus the fact, if you add in the equity sell-off, which we're going to have, I think, which I believe is going to be 50 to 70%, maybe not all in 1 year, but I think that will bring new money into those markets as well.
How about that? I did not know. I don't think I've heard you talk about equities recently. And again, we're on the same page there too. I didn't realize that we were.
Yeah, Dan, I feel like I've been listening to you, Dan.
I know. So we're brothers from another mother here. So are you? My thesis is simply we're coming out of the biggest financial mega bubble in all recorded history. Bonds, stocks, private equity, venture capital, the whole thing was really inflated. And, then we have a Fed that is aggressively tightening. What do you see?
I see a moronic Fed that has no clue, which is not a surprise. If you go back to the original mandate, they're nowhere near what the mandate of the actual Federal Reserve is. So, never has the Federal Reserve raised rates into a recession. And you can debate the issue of whether we're not in a recession or not. We're in a recession. Okay, that's the bottom line. And we can, you can change the metrics all you want as the government and say, well, this is not considered a recession anymore, but it's a recession. So the Fed, in their own ignorant way, continues to hike rates into a recession. Don't get me wrong, rates should be higher, but they should have let the free markets to determine what the rates are. Because if you look at some of the peer-to-peer lenders, or you look at, for example, what farmers are paying, they were never paying very low interest rates to begin with. So who's kidding who? The federal funds rate is simply the bank lending rate to one another, not to the public. And I think that the Fed is dead set on getting the 10-year notes up to 6%, although they're collapsing a little bit, while we're recording this. But I think that we're going to see a real mess with a real shot at stagflation, which would be obviously the worst possible scenario that you could dictate here. But when you have a government that has no mind on a budget and refuses to stop spending money that we don't have because they have the taxpayer to bail out everybody, what are you going to end up with? You're going to end up with a big mess. And that's where we're headed. And I think the banks will be, once again, have to be bailed out once again, because I don't think the banks, despite the news we get on their audits, are actually solvable.
Oh, so yeah, the narrative on banks has been, well, after the financial crisis, they've all got more capital. So it's, we're not going to go back there again. But you're saying that's not true.
I'm saying we're going back there. I would put the level at 97%. You can never put it 100 because obviously that would be silly. But I think there's no way, if we had a real audit of the banks, and we had somebody who was not the government, not somebody who was the Federal Reserve, going into these banks and doing a true audit, I would say they're dramatically over leveraged once again. During COVID, they allowed them to go past that stupid fractional banking law to begin with. Okay. So now I think you're going to see the same problem repeat itself. Look what's going on in the housing market already. Housing is collapsing. The mortgage rates are going to the moon. And I've never seen this in my life yet, but brand new homes are now being reduced in price. I've never seen them drop prices before.
Yeah, I guess I'm less clear on housing. I'm foggier on housing because I do see some price decreases, but the supply-demand situation is so tight. I just, that fundamental situation of very low inventory with so far still, a reasonable kind of demand. I'm less. It's logical to me, but I'm less likely to feel that way. I think, but I do agree the evidence is mounting here.
Well, just to clarify my point, the housing no longer has any real value. Housing is based on interest rates. It's based on money. Okay, That's how much is it by the month? What can I afford to buy? It's that simple. There is no longer that great American dream of owning a home that would appreciate in value over time during a reasonable market without a Federal Reserve intervention in interest rates. And you would sell your home later when you're ready to retire, and that was part of your savings plan. You'd move to a smaller house, you downsize. I don't see that anymore. To me, the housing market is all based on artificial interest rates. And when rates are low, housing is obviously very fast and moving. And I don't see the same demand you hear. Now, I have two homes, one in Chicago and one in Las Vegas. In Chicago, I took a beating on my house I sold. I had to pay up for the house I had to buy. And here in Las Vegas, my house that I bought here is up a fortune, but now I can tell you I couldn't sell it probably. And of course, the new housing developments around me, I just got a note that they're dropping prices everywhere, 10 to 12% at retail price.
Right. And a lot of people, another point that's valid here is a lot of people are stuck in these sort of 3% mortgages. You can't sell out of that and then go take on 7%. They're,
Exactly.
in the shoebox. So, yeah, I mean, it's a good argument. But I want to talk more about the grains that you mentioned. I know less about this than metals and oil and gas. In those areas, we've seen what happens, right? The investment has plummeted over the last several years for various reasons. In oil and gas, of course, the green folks are threatening to put them out of business, and their investments are 20-year investments. So you're not going to make that, right? You're going to pay it out in dividends and share repurchases, which is what they're doing.
How silly is that? I mean,
oh, yeah.
I mean, I go, and I believe oil is going to new highs as well, by the way. Okay. But how dumb can any human being be to buy into this BS climate change? Again, I'm not a believer in climate change, but you are. It's okay. I don't have a problem with it. I don't say we shouldn't do something about it. But at what cost to the American consumer do you want to get to this green energy? They have no plan. All they have is a plan to take more money out of our paycheck and not put us into a real deal yet. Versus we have the natural resources where we have in this country today, without affecting the environment, a 300-year supply at current usage. Okay. And that's just in the Permian Basin and all the places that you can get it easily. But yet they continue to talk about this ridiculous green energy program, but they have not come up with a plan of how we're going to get it done, how it's going to cost, not to mention the power grid, which couldn't support what they want to do anyways. You're already going to have rolling blackouts from the biggest power grid goes from about 13 or 14 states, from the east to the Midwest. Okay. They're going to have to already telling you there's going to be rolling power blackouts during the summer. So how are they going to charge their electric vehicles?
Okay, Bubba, don't worry about this one. I got this one figured out. Because when these green folks realize that you're going to need a new Escondido mine, the biggest copper mine in the world, every year for the next decade, they're going to go, oh, we didn't mean that. They're going to freak out when they realize that what they're calling for is the biggest mining boom in all of history. I think they might tap the brakes a little bit.
Well, I don't know. They don't seem to have the intelligence to put the brakes on it yet. That I have to be quite honest.
Can't argue.
On a related note, I have to hop in here on. It's a different circumstance, but I mean, this week, National Grid in Britain fired on their coal plants for the first time ever because of supply. Now, that's a different circumstance with the war going on and everything and the supply there, but still, it's this in the same vein of, they've never used coal before, and now it's 2023, and all of a sudden here's the need because, in part because of this whole green energy push.
You nailed it. You realize that we are burning globally a record amount of coal. Okay. And they're continuing new coal plants are coming on every day because, of course, how are you going to produce the electricity that you need to get there? This goes back to Obama when he shut down the coal miners in 5 minutes. Instead of saying, hey, we're going to eventually end out coal, here's our plan. See, what the problem is the government's left to make too much of a thing before they give you a plan and how much is it going to cost you to get there. So the coal is going to continue. And if you think that we're going to change the carbon footprint when India and China are 40% of the world's population, and they're never going to stop burning coal unless they find a cheaper source. And you think a cheaper source is going to be more carbon clean than what they have now? I don't think so. I think this is a big joke is what I look at it as.
All right, I want to head back to the grains, though. My point was, do you see the same lack of investment in grains that we've seen in, new copper mines, new oil and gas?
I think grains have been pressured by a lot of the funds. I think that they're actually trying to buy and trying to suppress price. I think, you have a very light trade right now. The volumes are extremely light. And what nobody's talking about is the massive amount of cost of input to these farmers, okay, which, hydrous ammonia, fuel, all these costs are rising, okay, yet on the futures board, you continue to see falling prices. But then you go to the retail store and you pay. I just paid 100% more for a loaf of bread from 6 months ago. Okay. Now, again, there's a fundamental problem in between there. Now, whether somebody's playing some games, we know Bill Gates wants to accumulate farmland. Why? Because he who controls the food supply controls the world. Is the government involved in this? Because what's going to happen this year, as we just go right into planting season right now, okay, is that a lot of smaller farms aren't going to be able to plant because the ratio of profit potential. Remember, when you're a farmer, you're working at potential because you're not guaranteed to produce that crop, right? We got to depend on weather. There's a whole bunch of things that go along with it. So if you don't plant, we already have a food shortage. You know, the war, the whatever you want to call it now in Russia, Ukraine, which is now about money, is about nothing else, is a big factor because not only do they supply 30% of the world's wheat, but they supply a lot of the components to make a lot of these chemicals for fertilizer that have really made great strides in developments to grow these products. And we don't have that. And we're already short grains. There's already been food riots in the breadbasket, they call it, which is around the Middle East, because they can't grow it there. So there's a lot of problems here that are illogical when it comes to why price at the wholesale end is so cheap when their cost of production is dramatically risen, not to mention that their interest rates continue to rise, which is a problem.
It makes me wonder, like, there are a lot of variables there. What if, for example, I'm not saying it's going to happen, but what if the conflict in Ukraine works itself out within a year or so, and then, I mean, that would seem to me a great deal of supply would return, and prices might not have the pressure under them.
You're talking about a year, right? Let's look at it from but let's look at it from the whole picture. This started well before the Russia-Ukraine conflict started, with a bad crop and bad production out of Argentina and Brazil, out of Australia, which are the other main components. So we're already short now. It's going to take a while to rebuild up inventory. Everything else has not slowed down. One thing about a consumable commodity, you're going to eat it or it's going to go bad. So we continue to consume it, and we're not replacing it as fast as we should be replacing it.
Okay, I see. We're not replacing as fast as we should be. I think that's what I was looking for.
Yeah, I mean, you got more population and more eating. It's not like gold and silver.
So you want to be long wheat, corn, soybeans, all the big
I'd like to be long. I mean, I'm concerned. Listen, I'm going to give you a full disclosure. In my trading portfolio, I'm short of them right here because the trend is lower. In my investing portfolio, in which I'm willing to hold on and go through the troubles, I'm holding long in all of them.
Sure.
Okay. And I do think in commodities, they call it a big market. I think we're due for a big market across the board and pretty much all commodities, especially the consumable good commodities. Gold and silver, I think they're going a lot higher, but they're not consumable. They're going to be needed for money pretty soon.
Again, same page, Bubba. So, all right, we like all commodities then. We like the consumables better, softs, sugar, coffee, cocoa, all those things.
I love them all. I mean, again, they're much more of a challenge. Listen, for the average investor or the average trader, those are not for the faint of heart, right? They have some dramatic moves. They trade in the middle of the night. There's a lot of hanky-panky that goes on in those markets. But overall, if you're buying at good prices, I mean, I could see a dramatic rise in soft commodities across the board. Look at how tight cotton's been recently, right? It has been unable to move out of between 80 and 85. But at the end of the day, I could see a mass explosion or a big market in all commodities across the board, including gold, silver, and oil.
Wow. That's a big idea. A big market, as you put it. I haven't heard that term before. It applies.
Bubba, what's the biggest thing that limiting supply, generally speaking?
Well, I mean, remember, you got to have weather. First, you have to have chemicals. You got to have money or be able to borrow the money to go ahead and plant it, right? Then you got to hope that the weather is helpful from planting through harvesting. Okay. So those are issues. The massive amount of hike in the cost of the chemicals are used. Hydrous ammonia, which is one of the biggest components for corn, is up 400%. Okay. Yet corn is down. All right. So we have so many conflicting issues, which leads me more to believe, because of the light volume right now, that you've got some pressure being put on it. And, again, I don't name names, but, again, I said that Bill Gates is looking to buy farmland. And if you can destroy the small family farms and turn them into corporate farms, it changes the dynamics of who's in control.
Yeah, that's a sad development. I saw another article about that yesterday. All right. So what about bonds? Just structurally short, waiting to be short again, or what do you think?
I am short at the moment. I'm assuming that trend's going to change with what's going with the number they're putting up this morning. Right now, I mean, they are flying higher, and I haven't seen them move this big for quite a while. But in my mind, I would love to just be short them all the time. Interest rates are not going down. We know that the Fed's going to continue to hike. We know that the Fed is so clueless that they don't know how to control themselves, and it's a very hawkish tone. And I do believe that the 10-year is getting to 6%, which would take these bonds down pretty dramatically, bonds and notes. And if you look at the inversion of the yield curve, which has never been quite this inverted, I mean, you can get 3-month CDs now at about 5%, okay, versus the 30-year bond is trading at about 4%. So think about that when you talk about inversion. Inversion is never good because the people who need short-term money are overpaying for it, and you're not getting enough for the long-term money.
Right.
Yeah, 1981 was the last time the yield curve, the 10-2 was this inverted. So yeah,
you got big problems here. This is not. They're not going away. No matter what they tell us, they're not going away without some major work. And of course, we keep getting away from the things that would help bail us out. For example, producing our own oil again. We should be the net exporter, not the importer. All right. We shouldn't be depending on the criminals from OPEC and Saudi Arabia that are gonna stick it to us. And you bet you can put this down and timestamp this. And I'll bet you we have a shortage of oil starting at the end of April, early May, when we get right into driving season. And when we get into peak demand, suddenly they won't have so much oil.
All right. Timestamped, Bubba. All right. Commodities, bonds. Where do we go next? And equities we talked about too.
You go that the economy's in a lot of trouble. There's where you go for it. You go
there we go.
That taxes are going higher, although we were promised that they wouldn't be hiking taxes. It's already started. It started with the little thing that nobody thinks about, the FICA tax increase, and yet our government doesn't have to live on a budget. If you and I lived the way they live, we'd be either in bankruptcy court or jail. Okay. There's one thing I learned in all my years in trading: you cannot borrow your way out of debt. At some point, you have to stop it. And because we live in the supply side economy world instead of the demand side economy world, and we allow failing businesses because they're too big not to fail, that's a flawed economic system, which is the Keynesian crap.
Yeah, and when government borrows, that's the act of printing. They're just borrowed new money into existence.
Just because
I can't get away with that either. I tried it. They won't let me do it.
I tried. Listen, they just like to keep torturing the middle class because, listen, they're trying to get the Great Reset. That's what I think that they're trying to get done here. You've got the squad that hates America to begin with, and they're trying to fleece the wealthy, but really the middle class, because let's face it, the wealthy pay their fair share of taxes. You want to fix and tax more on the wealthy, change the tax code. Okay. It's tax avoidance or tax evasion, right? So if you know how to avoid taxes, then you can avoid them. But, the middle class, they don't have the money to spend millions and millions of dollars on accountants every year to get this thing straightened away.
Yeah. Yeah. The tax code, boy, we could do a whole show on that.
It's pretty big.
It's pretty big. That's the understatement of the year.
It should be 50 pages. It's 50 million pages.
It's 50 million, I think.
That's right. It's funny. So many of the things that you've said, I've actually written them recently. This is, and I didn't know we were that much on the same page. It's just sort of hitting me in waves here. So let's try out another viewpoint and see if we agree. I think a Fed pivot is like nowhere in sight, and people still keep talking about it. They're convinced that, the Fed will have to cut rates or stop hiking. Whereas my paradigm is that Jerome Powell is looking at Paul Volcker and saying, look, this guy was hailed as a hero. He caused not one, but two recessions in 80 and then 81, 82. And, he hiked up to 20% 4 times. He smashed rates up to 20%. Like, and the guys before him, Burns and Miller, like, they're not hailed as heroes. They're the guys who didn't get the job done. So what's his incentive to stop hiking or cut or anything? I think the paradigm is, I want to be remembered like Paul.
Well, he's not. He's going to be remembered like the idiot that he turned out to be. I really thought he was going to be the right choice when he came. He came out of private equity, right? And yep. I didn't realize that when you go on the ivory tower of the Federal Reserve, you become an instant moron, and you lose all track of real reality. They're not going to stop raising rates. They can't stop because they let this get too far, because they got involved in a bank bailout, because they made all these accommodations. And you can go back to Ben Bernanke, who in 2013 puked when he tried to start hiking rates then, which was the correct move to make back then. But he kowtowed out to the market, and now 10 years later, here we are, and they're not going to stop. And this does not work out logically. It does not work out well, and it does not have a happy ending because we have a big problem in the jobs market. That's the next problem. Which again, you cannot keep hiding from the fact that you're destroying the people that pay the most amount of money to everything, and that is the middle class. And that's exactly what they're doing and in the process of doing. And they really need to get back like on the gold standard, right? And if you remember the Bretton Woods Act, before Alan Greenspan, who in my opinion was the worst Fed chair and was the start of this bubble building, okay, yep. He was a big fan of not going off the gold standard. But the minute he became Fed chair, he said, "Oh, we got to get off the gold standard," right? Yeah. Which we were already done by then. But so he started the fueling of all this bubble building and phony assets. I mean, let's face it. I've been trading since 1980. When I started trading, the Dow Jones was $800. Okay, now it's 34,000. Okay, did we really have that much growth and increase? I don't think so. I think it's all error and money supply, which your dollars buy a lot less. I would argue that you look better in 1985 than you do in 2023.
It's funny about Greenspan, isn't it? All that stuff he wrote when he was hanging around with Ayn Rand about the gold standard. And then, man, he gets that job. First of all, it was a tell when he accepted the job. This wasn't like an objectivist, gold money standard guy. It was like, oh, whoa, wait a minute. How can he possibly accept that job? And of course, it turned out, as you say, he was like the godfather of the loose money era,
right?
And we know what happened after that.
Nothing good.
Nothing good. Another point that I keep making about the Fed, agree or disagree, Bubba, I don't think their tools are suited to the purpose. This mandate, which is, a modern thing too, this dual mandate of maximum employment, price stability, which is a baloney kind of a phrase anyway. You can't do that with essentially manipulating the bond market. I don't understand. Like, how does anyone think that they can be competent? I think they appear incompetent because the mechanism just isn't right. You don't try to tweak a $26 trillion economy by manipulating the bond market and then be surprised when you blow asset bubbles.
Well, I think that you are correct. Okay. I think you go back, you have to go back. If you go back to 1913, right? Warburg, Rothschild, Rockefeller, and JP Morgan, four great human beings that can't wait to help Americans, right? Can't wait to steal all your money. It's as they started in England in the 1600s, right? So we know that the central banking system is flawed to begin with. We know that banks never had enough assets for the fractional banking. And that's another story that ruins us, because not only does the Federal Reserve or the central banking system around the globe have the ability to create more money, but the banks have the ability to create more money because they're lending out at 10 to 1. And not only are they lending out at 10 to 1, but they can borrow $1 million, for example, from the Federal Reserve, turn that into an asset that now allows them to lend out another 10 million. So they never pay a dime of interest. Only the customer pays all the money for them. They just make the profits. And God bless. They go out of business. They can't meet demand. Oh, well, the Fed will bail us out, which means that the American taxpayer will bail them out. What kind of crock is that? They should have let the bank in 2008. They should have let the banks that didn't have the financing go out of business. Guarantee the depositors and excuse me, and the investors' money, not the banks.
Yeah, most people don't realize. They think, the Fed prints money, which it does. They think the government prints money, which it does. But most of it is created in the banking system by that mechanism.
Exactly.
Little discussed. We don't discuss this anymore.
Well, because
why don't we talk about
we
this?
hide everything.
Yeah.
Listen, when you have too much power in too few people, and you have voters that won't get out their ass and go vote at the polls, that won't stand up for what's going on, because again, they're basically, in a word, stealing from the middle class. I always go back to the middle class because that's who I identify with. This is the problem when you continue to jack the prices and you allow a government to propose a $6.8 trillion budget. Are you out of your mind? I mean, this is a joke that they don't live on a normal budget like an average person has to live on. Okay, so this, you let all these things go by while you're reducing value. It's amazing that you always hear in the commodity world, especially, well, the strong dollar is hurting the sales of commodities. Why is the strong dollar? Nobody's yet been able to explain to me what that means. If my dollar is worth less, am I not lowering the price of the product I'm selling? So if the dollar's too high, why don't I just lower the price if that's the real problem?
Right. I mean, I see what you're saying. Yeah, it's the strong dollar is an interesting subject too, isn't it? Because here it is, 60% of global foreign exchange, and 80+% over a couple of decades, 90% of global transactions. And one of the sticky points in my head when I think about, well, it's fiat currency, so we know where it's going to wind up, historically speaking.
The garbage.
But it is, but it's hard to sell anything in this world without buying dollars. So there's this constant bid under it. And I wonder, I almost don't want to find out what breaks that bid. I almost don't want to find out, because I'm not sure that world would be a fun place to live in.
Well, I think you realize this, that there's a development. They're trying to create a digital currency, not cryptocurrency, but digital. And in my opinion, this is where it really gets murky. In my opinion, there not only is it going to be a digital currency, but I think they're trying to make a global digital currency, which would really, who are they really accommodating if they do that? China. Because China wants to be part of the whole package. China would like to be obviously the reserve currency, and they're not yet. And, they're the second most powerful, or maybe the first most powerful right now. That's hard to say. We don't know that for a fact, but, they're trying to, be a much bigger player in that world. And this is a way that also helps with the Great Reset, is where now you have no more paper currency, you have no more script, and suddenly you are tracked from the moment you're born to the moment you die. Okay, with whatever you do, you do things that you shouldn't be doing. You got to get tracked, because there is no currency, which I believe brings in the strength into the potential cryptocurrency market, which I do think is real, and I do think it's a great opportunity. However, it has to be with the risk capital that you're willing to lose in case I'm wrong.
Right. I feel the same way. I want Bitcoin to work. I love the idea. But, that thing doesn't trade like a currency. It trades like a .com stock.
It trades, but remember, it does trade 24/7.
Yeah, I was going to say in the middle of the night too, right? Yeah.
Right.
So,
and
on weekends.
Russia's using a lot of it. The Russians been doing a lot of transactions in Bitcoin. Listen, Russia and China have been using the blockchain technology for 10 years. Okay, which was obviously the whole thing behind this. I mean, I think that eventually they'll settle out, and there'll be a few cryptocurrencies that are going to be there. And I think Bitcoin's one of them, and I think Ethereum's one of them. But again, I think that you missed the first boom, right? If you were lucky enough to be a part of that, which I was not, because I had a partner who was an economics guy that believed in the way that this is set up, which I don't. Okay, and you can go back to my radio show back when I said to him, hey, this is the Fed stinks. They should let the banks close. Okay. Unfortunately, he passed away, but he was, an American trained economist, which again, I think economists have no clue, because they refuse to say in front, we're in a recession. Okay. 10 years from now, they'll tell me we're in a recession. I'm telling you now, we're in a recession. I don't know any Americans that aren't in a recession right now. Jobs stink. You got no more benefits because the jobs they're showing are part-time jobs that don't have benefits. Okay. You've got stores allowing criminals to steal because it's cheaper and because we have no law and order anymore. So you've got an entire collapse, which can't be good for anything long run.
Boy, that's, I feel like I need to pull an optimistic message out of my keister after that.
Optimistic message is that, fortunately, in this country, we get the vote every 4 years if we get off our lazy ass and go do it. Okay. And we get a chance to make change. And certainly, if we go back in the history of America, there's been times, maybe not this exact way, but bad times in the past. However, the equity markets have still been proven to be the greatest investment of all time, gaining an average of 8.5% year over year since in the inception and over 10% year over year since 1950. So I think that's a positive message to take and send, that this is probably a great buying opportunity. And if you don't over leverage yourself, you can probably make a lot of money through the next few years once this thing does reverse and turn back around, unless we are just too lazy to step in front of it and stop it from happening, which I hope we are not.
Yeah, I agree with that. If you have enough time, depending on where you are in life, folks get rich in the stock market by waiting till it falls and, charging in.
And with short-term interest rates, the elderly should be able to deposit and get some nice capital as well. So listen, it's not as dire from an individual person, but when you're involved in the markets day to day and have been so, like me, for 44 years, I've seen these things before. And in the market industry part of it is very dire right now.
I see. So it sounds to me like you are, as a trader, as a professional, you have no choice, especially in a sort of macro sensitive area like commodities. You have no choice but to pay attention to these things. They mean a lot to you. But an individual investor, they can contribute to their 401k, wait 10 years, and should be good.
100%. Listen, let's be one thing clear. I am 100% invested in equities, okay, with my entire retirement, my entire 401k, my entire profit sharing. Now, I hedge. I have a model that hedges them. But either way, I would be 100% invested. I can trade whatever I want. But I will say that I don't see the pattern of the average of 8.5% to 10% year over year changing at any time soon. And if you say that it's time in the market, not trying to time the market, you'll be a much happier person. Quit looking at the Wall Street Journal, quit looking at your iPhone, and just leave the market alone, leave your 401k alone. And I promise you, 20 years from now, you'll be a happy person. And if you're not, we got much bigger problems.
Yeah. Well, from a common sense viewpoint, lower valuations and higher rates are better for longer term return, right? I mean, that's like a no-brainer.
Everything is setting up for the average investor that can control themselves and not try to time this market and not get caught up in the nonsensical news that you hear those dumbos report all the time, which is just to get headlines and advertising dollars. Okay. If you just understand that if you're in good companies, that you think are going to be in business for the next 20 years, then you're probably going to be in pretty good shape, because history has proven that companies like that make a lot of money and eventually you'll be in great shape.
Right. All right. Hey, that's a good message. I think we have come to, it's time for our final question, which is the same final question for every guest, Bubba, no matter what the topic, even if it's not finance related, same final question. You have answered it once before, but I hope you forgot it, because I like to spring it on people. And the question is simply, if you could leave our listener with a single thought today, what might it be? And if you've already said it, by all means, feel free to repeat it.
I think that the investor is exactly that, investor. I think that because of technology, we've gotten too much into looking at our portfolios every minute of every day with every move in the market. I think your best bet is to turn off the iPhone, turn off your computer, quit looking at the portfolio every single day, because you're not going to be able to adjust a lot of things anyways. And when you want to sell or when you want to chase them and buy them, you're always doing it at the wrong time. Continue to make your contributions to your IRA, your Roth, and do your thing. And don't let the day-to-day news get to you.
Brilliant. Love it. All right, Bubba. It's always a pleasure, man. I love talking with you, and I hope we'll have you back soon.
I hope so, Dan. And Corey, it's nice to meet you as well. And thank you guys for having me.
You too. Thank you.
Many mainstream analysts are predicting that stocks will recover soon. But I say we'll instead witness a cash frenzy unlike we've experienced in 21 years before stocks recover. And I'm urging Americans not to buy a single stock until they see it. I predicted the Lehman Brothers crash in 2008, and I called the top of the NASDAQ in 2021. But this is the number one most important thing to pay attention to for 2023. And I'm not talking about another market crash or politics or inflation or any of these other things. As all this unfolds, the financial consequences of what I'm talking about could last for several decades if you don't understand what's happening. There will be winners and losers, and now is the time to decide which one you'll be. This is why I strongly encourage you to read about my warning totally free today. It's all spelled out in a free report we've put together. Get the facts yourself. Go to www.stockdeadzone.com to get your free copy of this report. You can learn how to get my 4 steps to prepare for what's coming. Again, that's www.stockdeadzone for a free copy of this new report. Always a pleasure to talk with Bubba. He's been around forever. He's traded everything. And as you heard, I had forgotten how much he and I wind up on the same page with all of these topics.
Yeah. You guys are in lockstep on a lot of things.
Yeah. I mean, like you say, he sounded like me. I mean,
right off the bat.
Or I sound like him. I don't know.
One or the other. Which tells you something, it's not. Yeah, I'm with him on a lot of things too, as far as the moronic things happening in the world, and also being optimistic in the long term, despite all of that nonsense as well.
Right. That's a real practitioner, isn't it?
Yeah.
And he said, look, I am short bonds for the moment here because the trend is down. That's a real practitioner. He doesn't care about having some consistent viewpoint that is a monolithic viewpoint. He's telling it like it is. He's in the trenches every day. Those are the best people to talk to. That's one of the big lessons I sort of learned from reading Nassim Taleb's books, Talk to people who are there from the bottom up, real practitioners, real risk takers, and anybody who kind of really makes something, really does something, rather than somebody who kind of, opines into a camera on CNBC for a living and reads teleprompters and stuff. It's a different class of folks.
Sure is, yeah. Skin in the game. It's you gotta. It makes a difference, and it was important too that he pointed that out. I think at the end, because a lot of what we talked about was kind of short term and different trading ideas and whatnot. And he talked about that, but then that's just a part of what the overall investing picture, which I think in most financial media, gets lost. Just the context and the perspective and just
right.
It's
they're buying on Monday and selling on Tuesday and saying, "We told you so." They always say, "We told you so," and the reality is, no, you didn't. Yeah, that's a great point.
Yeah, these are all like trends to watch, obviously within a bigger picture. So that was good. Thanks for having me along for that one.
Yeah. Oh man, to ride along with Bubba is a good time. All right. Well, that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com, please. And also, do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com. or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, until next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.